I'm Melissa Lee, and this is Fast Money. Tonight's trader lineup: Karen Feinerman, Bonawyn Eison, Steve Grasso, and James McDonald. Tonight on Fast, records fall on Wall Street. So what should be your next move? The stocks at all-time highs. We're trading the rally straight ahead. Plus, we're gearing up for another mega week of earnings. We're breaking down the 4 names that need to be on your watch list. And later, our chart of the week. This stock adding $172 billion to its market cap since Monday. That name and how to trade it straight ahead. But we start off with the road to records. S&P, NASDAQ, Russell 2000 driving to their highest levels ever. But there is something big brewing in the bond market that could cause investors to yield. Let's get to Cornerstone Macro's Carter Braxton Worth with more. Carter.
Well, surely an exciting week for equities, of course, but in many ways, the bump up in yields, continued bump up, is equally important and exciting. What we do know, of course, is that today was the highest close since the pandemic low. 1.165, and we reached 1.186, getting awfully close to that 1.2, 3 simple charts. The first, this is a 3-4 year chart, and it's just the exercise of examining trend. It doesn't matter whether this is cotton or Uber. Point is, when you have a wipeout, if you don't go out of business, so to speak, and yields can't go out of business, you base and bottom, as measured by your moving average. You can see there the smoothing mechanism, the 150-day moving average, is flattening and is rising. Second chart, it's the exact same chart, but it's just using a trend line instead. And if you think about it, all that a moving average is an automated trend line. The point at which the 150-day turns is the point here on the second chart where you break above the downtrend. And so let's zero in on the last chart, the goings on since the low. Now what this tries to highlight is you see that sort of epic intraday low, that's 32 basis points. That's March 9th. That was a Monday. And then within moments, 6, 8, 10 sessions, we were already back to 1.28. And you can see those 2 parallel lines. Those are the levels that matter. Now, the uptrending line, the ascending line since the low, is the path we've been on. It's very orderly, it's steady, and it's sequential. And the sequence calls for more of the same. It would call for about 128. And so if you just, last thing, look at that spike low in the pandemic, and you white that out with your eye. Forget that intraday low. Basically, rates bottomed at 60 basis points plus or minus. And after 4 or 5 months, then they've slowly been moving up ever since. The sequence calls for 125, 13 here.
Is that going to cause, Carter, equities to stutter, do you think?
No. Well, I mean, equities can stutter for any reason, but
sure.
Whether the cost of 10-year money is 90 basis points or 130, with 60 basis points or 110, it's still 10-year money that's readily available and cheap. I think you'd have to see yields getting back closer to 1.6, 1.7 before you might get a scare in the equity market. Just to think about this, we were at 1.9, right? Almost 2% the day the pandemic came to the United States. So getting to 1.4, 1.5, it would have to be higher than that.
All right. Carter, thanks. Carter Worth, we'll see you in a bit on options action. So with stocks touching all-time highs, will rising rates wreck this record rally? Carter obviously says no. It'll take up 1.6 or so before that happens, Karen. It seems like then we could be in a sweet spot here for equities where yields are telling us that the economy is doing better, but money doesn't get too expensive.
Right. I think that's where we are. This market is in a sweet spot, and so we're at all-time highs, which isn't shocking not because of where the economy is right now, but because of where we think it's going to be. And we think we're going to have a dramatic improvement. And I think that we're also going to have stimulus, although I think that's getting pretty well priced in. And I think we're also seeing good earnings. So many companies have been able to shift and even, do extraordinarily well in the pandemic. And so this is a great time for earnings. I think, though, that at some point, we often talk about risk premium. When rates get high enough, that equity risk premium will need to go up, and that will mean multiples will come down. And I think that will be the hardest on the super high flyers, the multiples that are just in the stratosphere, and relatively better for the banks. They'll benefit anyway from the steeper yield curve, but also from being a low PE kind of industry.
Right. I mean, we can also talk about the level of rates till the cows come home, but it's the pace at which we get to that rate that's going to make all the difference. I mean, we saw the market reaction, was it a couple weeks ago, James, when rates all of a sudden went higher? I mean, markets panicked a little bit. Maybe I'm overstating that, but it certainly reacted. So what are your thoughts on that? Because if we do have a reopening trade that happens a little quicker than we think, then those rates could spike higher quickly.
Right. And so we think at our shop, a 1% increase in 10-year yields, it's going to slash S&P PE multiples by about 18%, NASDAQ 100 multiples by more by about 22.5%. And so we think we'll get a big sell-off there. And the issue right now is that the rates are too low, given the growth in inflation expectations. The biggest risk is if the market starts to care, right? And so a 10-year U.S. Treasury at 115 basis points and 2-year at 11 basis points. It's the steepest we've had since May of 2017, and it implies a positive economic outlook, which I don't think is there. Obviously, inflation expectations at 2.3%, highest since April 2013. This inflation number is going to rise further arithmetically with a base adjustment. And so the Senate just passed the budget resolution. I think we're going to step toward approving Biden's $1.9 trillion stimulus bill by a simple majority. And this is going to drive us to those increased rates where we see market risk, as you said.
Yeah, or maybe that spread implies the economic activity that we expect to see. Banks had a fantastic week, Bonawyn. I mean, buried amidst this GameStop AMC roller coaster, we had the financials close out the week more than 6% higher.
Yeah, absolutely. It tends to get lost in all of the noise here. I mean, just to put this in context, we're still near historic lows as it pertains to rates, right? So yes, clearly we've all talked about the pressures and downward pressures that upward pressures in rate might lead to. But in what we have seen from investors is a propensity to step further out on the risk curve. And with rates here, the alternative investment just isn't there. And to play in more speculative areas, right? And then technology has kind of shifted now to somewhat of the focus. It's been pervasive in a lot of other industries. And so what I would look at is separating pre-revenue or at least pre-EBITDA type of companies in technology vis-a-vis established growth companies that are still highly profitable. That is where I'll start to look for the breakdown. Specifically from my lens of looking at things.
Yeah, so when you say that, Bonawyn, it goes, Steve, to some of the earnings that we saw this week, which were very good.
Yeah, so when you look at the earnings that we saw, it was in the tech companies. So you've really taken your eye off the ball as far as a market participant. All this conversation leads me back to the value over growth rotation. And I think Bonawyn hit it on the head there. We're at historic lows in rates. I'd start to worry at 2, but that's a stutter step. I'm not worried that the market's going to cave. I'm worried that people are going to have a knee-jerk reaction, start to sell the market off, and then realize nothing. We made much to do over nothing. So as long as the economy starts to improve, you have vaccines rolling out, the reopenings are starting or will start. I think that's the major concern. So I think the market can move higher, but we're talking about guidance, outlook, and who knows what it looks like middle of the summer. If the vaccines don't roll out the way they think they're going to roll out, then I'd start to worry, but I'm not going to worry about rates just yet.
Yeah, I mean, investors need the goods, right, to back up higher yields. 2% is not a problem if we have the actual growth, if we have the actual earnings lining up to support a 2% yield, Karen. I know earlier in the week, Karen, you were noticing spreads while everybody else is looking at Reddit and Wall Street bets and the impact on bank stocks here.
Yeah, I mean, I think bank stocks were a little bit oversold, but yeah, this yield curve, I think I don't know, it was Carter or James that said we haven't seen it since May of 17. So that's, almost 4 years. And that's reflecting, I think, an economy that's going to be booming. And you just wonder at what point does it get too hot? And, down the road somewhere, there will be a taper tantrum. It'll be ugly for sure. I don't know when it'll happen, probably not this year, but that does seem to be the end game at some point. But for now, it's all good.
And I guess that's what we've been saying for months and months and months and months at this point. I mean, I guess the ultimate concern, James, is things pick up so quickly, too quickly almost. The inflationary pressures really heat up because then that bounces the ball back into Jerome Powell's court.
Yeah, and there's just been a ton of bullish energy in this market like we've never seen in history. I have been absolutely blown away by the energy behind small caps over the last 3 months, up over 30% over the period. And if you look at the NASDAQ Bank Index, up 46% in this 90-day period. Ton of energy. That momentum has taken us through. We had a little bit of a pullback last week, following through to the upside today, breaking out at new all-time highs. I think we saw a microcosm of the energy that's behind the retail buying frenzy on the Reddit and the GameStop story, but that same story is trickling into the overall markets. And so the boom is there in stocks, and frankly, Main Street and Wall Street have never been more disconnected.
Anything looking too hot in your view, Grasso, in terms of stocks, either individual stocks or sectors?
I think the stock market has looked too hot to me, and technology stocks have looked too hot to me, and the Zooms and the Pelotons and all the work from home stocks, because we have to get to the end of that technology line as far as the bullishness and the work from home stocks. But I am glad that I fought my gut to sell the market, because I could have sold this S&P at 3,000. So when you say, does it look too hot? As long as the Fed's in your corner, as long as there's stimulus, I think the market can go higher.
All right.
Shepard Smith here. Thanks for watching CNBC on YouTube.